today, oh, here we go. My name is David Osborne. It is good to be with each one of you. And welcome to today's session, Advanced Financial Statement and Cash Flow Analysis. Now, as was mentioned by Stephanie, our administrator, today we have our first of our 3 series or classes. Tomorrow we have Advanced Tax Return Analysis for the banker. And on Friday, we have Advanced CNI Lending in the morning, Commercial Industrial Lending in the morning, and Advanced Commercial Real Estate Lending in the afternoon. How many of us are going to be here tomorrow? How many of us are going to be here on Friday? Good. Okay. So Ali, you'll miss the middle? Okay, no problem. Good. Okay. And we've got from the virtual audience, we have Anthony. And Anthony, if you can you speak? Like was mentioned, please don't use the chat. Preferably, if you will please unmute yourself and just say, I'm here, I'm here. Okay. And wait a second. We've got, hold on a second. I just realized, wait a second. We've got Anthony right here. Oh, okay, wait a second. I got that wrong. Michelle, are you with us? Michelle, if you can unmute yourself. Okay. All right. How about Cindy? Can you unmute yourself? Can you unmute yourself, Cindy, please? Okay. All right. And now wait a second. Jonathan. We've got Jonathan.
One Jonathan.
Wait a second. We've got 2 Jonathans. Okay. I'm like looking at this. Wait a second. And your last name, Jonathan, is? Stroud. Okay. We're going to say Jonathan S. versus Jonathan R. Jonathan R., can you hear me? If you can, we can see you. If you can unmute yourself and just say you're here. Okay. Oh, we can't hear you at all. Let's see. Hold on. Let's see. Hold on. Okay, so we've got, all right, hold on. We've got Patricia. Wait a minute. Okay. Okay. Trisha Brown, can you unmute yourself?
I'm unmuted.
Now we can, oh, excellent. We can hear you. Great. Okay, and is Michael with us?
I am, yes, I am here.
Excellent. We can hear you as well. Excellent. Okay. So we're going to just go there. Trisha Brown and Michael. Do you go by Michael or Mike?
Mike, but it doesn't much matter.
Okay, we'll go Mike. We'll do Mike. Excellent. Okay.
And Trisha would be the same as Patricia. So I'm one of the same.
Yep, I figured that. Okay, so we got Trisha, we've got Mike, and let's see. Okay, hold on one second. And we've got Jonathan R. Jonathan R., can you unmute yourself? We can see you. Can you unmute yourself?
Yep, I'm here.
Whoa, we can barely hear you. If you can somehow turn up the volume. Somehow it's just really faint.
Better now?
Oh yeah, that's better. Excellent. Okay. Jonathan R. And how about Cindy? Do we have Cindy? If Cindy's there, if you can unmute yourself, please. Okay, so we've got Jonathan R. Hold on. In the virtual. We got Trisha, Mike, Jonathan R., Cindy, and then Michelle. Is Michelle? I don't see. Can you help me with this? Michelle, you don't see Michelle, right? Okay. All right. We don't see Michelle. But we do have Jonathan R., Trisha, and Mike. Okay. And let's see. So we're just missing. Let's see. Michelle, and Cindy. Okay. We got at least 3 people that we can hear. 3, we'll come back to you. And in the ground base, we have Josh, Noel, Allie, Sawyer, Jonathan S. versus Jonathan R. Delisha, Anthony, and Christian, right? So we've got Christian. Whoa, everybody put your name over that nameplate if you would. Put your hand over your nameplate. See if we've got the name. We've got Christian, we've got Anthony, we've got Delisha, we've got Jonathan S. We've got Sawyer, we've got Alan, we've got Noel, and we've got Josh. Is that right? Man, we've got them all. And we have Trisha, Jonathan R. versus Jonathan S. And we've got Mike so far. So we're just missing, let me put a question mark, Michelle and Cindy. They may be listening even to the recording. Okay, but at least so far we've got Trisha, Jonathan R, and Mike. So we have team number 1, team number 2, team number 3, and team number 4. Trisha, are you going to be with us all 3 days?
Yes, I am.
Excellent. Jonathan R, are you going to be
Yes.
with all 3 days?
Yep.
Excellent. And Mike, are you going to be with us all 3 days?
I will not. I will be here Monday or today and Friday.
Okay, skip, kind of like Allie, just skip one day, no problem. But you'll be here today and Friday. So most of us will be here for the whole series. Excellent. And well, it's great to be with each one of you. My name is David Osborne. We're going to start with doing a quick team activity. Team 1, team 2, team 3. I recognize the virtual team, you're not together, so you can't really do this activity, but the ground-based teams, spend just 1 minute, introduce yourselves to each other, and choose a team leader for the day, a team leader for today's session. Everyone's going to participate. Everybody's going to participate. In the 3 teams on the ground-based and in the virtual, Jonathan R., Mike, and Trisha will participate, but we need for the ground-based a team leader. So most of the questions will go to you, but everybody's still going to participate. Is that a fair deal? Doesn't mean you have all the answers. In fact, sometimes the team leader doesn't have any of the answers. They're more new to the subject, and so everyone else is feeding them the answers. Is that a fair deal? Let's take just a moment and introduce yourselves. Okay. Okay. And Jonathan R., if we can have you even raise that volume even a little more, that would be great. We can hear you better than before. Before it was just really, really faint. So, all right. Trisha, can you see me, by the way?
Yes, I can.
All right. Jonathan R., can you see me?
Yes.
Good. And Mike, can you see me?
I can, yes.
Excellent. Good. Now, I'm going to be rotating around the room, and I do move. You'll see me move. I move throughout the day. Okay. Oh, wait. So you're just going to be here today? Yeah, you can call this. I've had people do this. I've had people do this all the time where they say, oh, wait a minute, I didn't realize it was 3 days. And then they call it, get permission just to continue. Okay, here we go. Team number 1, who's going to be the team leader?
I can't be.
Josh is for today. Team number 2, it is Sawyer. Team number 3, it is Delisha. Excellent. All right, so we've got team number 1, 2, and 3. Team number 4, of course, because they're not together. Sometimes I'll have a bank that will have like 4 or 5 people in the same conference room, and they're virtual, and then we choose a team leader. Does that make sense? But you're 3, and all 3 of you are in different banks. Is that correct, Trisha? Okay,
Yes.
good. Okay, here we go. What we'd like is just a brief self-introduction. Your name, your bank, What do you do in the bank specifically? Not your title, but more your function. Your name, your bank, name, bank. What do you do in the bank? And where are you physically located? Here in Michigan or Wisconsin, whether you're ground-based or virtual, we'll start with team number one. Josh, if you can give us a brief intro.
Yeah,
Please.
my name is Josh Ball. I'm from Marquette, Michigan, the UP. Work for Nicolay Bank. I'm a commercial banker tasked with maintaining deep kind of relationship, business relationships with the bank, as well as growing the portfolio.
Based in Marquette.
Yep.
I was just in Marquette a month and a half ago, training for Michigan Bankers Association.
I was supposed to
Excellent.
be there for that. I got COVID.
Whoa, whoa. Noel,
No, I work from,
and really loud for the people in the virtual audience to hear.
so Noel, Tri-County Bank, a credit analyst, new to the role. And we're in Brown City, Michigan.
Which is where, relative to Lansing,
East.
okay?
Flint.
An hour, 2 hours?
It was about an hour and a half drive.
About an hour and a half drive. Okay, thank you. Ally,
I'm Ally. I'm from First State Bank in Saginaw, which is just north of Lawrence. And I'm also a credit analyst. I underwrite commercial.
okay, great. Sawyer,
I'm Sawyer Fortin from Charlevoix State Bank. I am a credit officer. I assist the loan officers with their analyses on commercial and some consumer loans. I work and live in Charlevoix, which is northern Michigan between Traverse City and Petoskey.
okay, thank you. Jonathan S.
I'm Jonathan Straub. I work at Chelsea State Bank, which is kind of between Jackson and Ann Arbor. I am the loan processor, financial analyst, so I'm kind of the catch-all for anything loans or credit related.
Great, thank you. Delisha,
So I'm Delisha Padula, and I'm from County National Bank in Hillsdale, which is south, bottom of the state. And I am currently a consumer loan officer, so I do all consumer loans, but working into learning credit analysts and commercial lending.
oh, good, thank you. Anthony,
I'm Anthony Custard. I am a credit analyst out in Appleton, Wisconsin. It's about 6 hours from here, and I do risk analysis on tax returns and different credit presentations and write-ups.
great. Did you fly or you drove? or-
Yeah, we drove.
Okay, down through Chicago?
I actually had to go up to Marquette, so I came up around through the UP and then Christian will tell you the way he came, but not
Okay,
that way.
okay. Christian,
Christian Jack at American National Bank, also in Appleton. I underwrite the loans and public credit.
okay, great. Thank you. Team number 4. Tricia, can you give us an intro, please?
Yes, so my name is Patricia Brown. I work for Choice One Bank. I'm a commercial loan officer and I'm located in the Western Michigan region. My office is physically in Norton Shores along the lake shore.
Got it. Thank you. Jonathan R., please.
Hi, I'm Jonathan Rantham. I work at the Stevenson National Bank in Marinette, Wisconsin. I'm a credit analyst and I do the underwriting for loans.
Got it. So you're north of Green Bay, almost to Michigan, right? To the UP.
Yep, just right by the border.
You bet. And Mike, how about you?
I am Mike McDowell. I am with First National Bank of America, and I'm a commercial loan officer, kind of tasked with growing and overseeing the Grand Rapids, Traverse City portfolio here. And I'm based in Grand Rapids.
Good, excellent. And my name is David Osborne, and I'm a business trainer, a contract CFO, college professor. As was mentioned, I'm based in, or alluded to, I'm based in Las Vegas. Flew in last night through Chicago, through Midway to Grand Rapids, drove across through the fog to this beautiful city of Lansing. and it is great to be with you. By way of introduction, I'm also a former commercial lender. For many years, worked at Bank of America for about 9 years, but also worked at 2 community banks. How many of us work at a community bank? Look at that. We all do. Trisha, you work at a community bank?
I do. I work at Choice One and I've been there for about 25 years.
Whoa. And you started when you were 2 or 3 years old. I'm just kidding. Okay.
Exactly.
That's it. Jonathan R., yours is a community bank, is that right?
Yes.
And Mike, how about yours?
Yes, yep, correct.
All the
Community
way,
bank.
all the way, so I can relate to your world. It is good to be with each one of you. I've trained in this room, as Stephanie, our administrator, alluded to, for many, many years in this room, and it's great to be here. And it's great to be back physically versus the virtual. And I do virtual training in this room extensively, especially during the era of COVID and the aftermath and whatever you want to call it. So it's great to be with each one of you. Today's theme, advanced financial statement cash flow analysis. Okay, we have 2 sections of today's material. Tomorrow, once again, advanced tax, Friday, CNI lending and CRE lending. If you will write this down, you should have this right there. In fact, I'm going to turn, so let me just turn the page. There we go. Whoop, that didn't work. Let me turn the page. There we go. That is done working. Here we go. Let's see. Let's give me a second. Let me see if I can get the mouse. Maybe the mouse will work. There we go. If you turn to page number 2, put that back. Just use that mouse. Here we go. Now you should have there in front of you, if you would. Okay. We've got my bio. If you've got a highlighter, for those of you in the ground-based and in the virtual, you have the material. You grab a highlighter. In fact, I encourage you, especially tomorrow in the tax class, to bring a highlighter. And the same with the virtual. Virtual, you're physically there, but we're physically here in Lansing. If you will please highlight my email address, dlosborn@cox.net. Got a highlighter or a pen? If you'd please, if you'll just highlight. My last name is unusual. Instead of the more common Osborne with an O-R-N, it's Osborne with the U-R-N. So Ozzy's, now Christian, Ozzy is my distant cousin, okay? He actually spells his name correctly. Ours is incorrect. Ours is the Americanized version. His is O-S-B-O-U-R-N-E, which is the correct Old Scottish, Old English. If you actually pronounce Ozzy Osbourne's name correctly, you would actually pronounce it Osborne. I'm really serious. He is my distant cousin. Now, please keep my contact info so that if you have questions, now during the session today, Thursday, Friday, you've got questions, don't hesitate just to stop me, raise your hand. Those in the virtual team, team number 4, just blur it out. Don't have to raise your hand. I know you can raise your hand in Zoom and so forth. Don't put anything into the chat. This is live. This is live. Just blur it out. Jonathan R. just stopped me and says, hey, David, can you explain that? Or can you go over that again? Or we had this issue just last week in the bank and and away we go. So please, please, live interactive, but keep my contact info. Ali, so a month from now, you're working on a deal and you're going like, oh, you got stuck. You've asked 2 people on your team at the bank or in your lending department, and you get 4 different responses because each person has 2 opinions. I'm just kidding. Don't hesitate. Felicia, don't hesitate to reach out to me and say, I got this question. Can you help me with this? Because I'm serious when I say this. I'm here for you. They'll emphasize 3 items. Number 1, I keep everything confidential. Number 2, I don't charge for this. I consider it as an extension of today's session. And number 3, I receive emails regularly. So with people that either been in the ground-based or the virtual, doesn't matter, doesn't really matter. And I've even had people, believe it or not, where I've taught the 3-day session, like we're doing this week, the advanced for Wednesday, Thursday, Friday. I have actually had people that for whatever reason could not physically be in the class on Wednesday today. They're virtual. They're like Trisha. And believe it or not, the very next day they show up physically because they had some conflict. They could not make it to the physical part of the class. And the very next day, on Thursday and Friday, they're physically with us. I've had that happen numerous times. So it doesn't matter if you're in the ground-based, in the virtual, or whatever the setting, please keep my contact info. Please, and I do receive emails regularly and on these subject matters. Great. Okay, here we go. Today's theme, here we go. Advanced financial statement and and cash flow analysis. If you'll turn with me to page number 3. Okay, here we go. At the top of page number 3. If you will please put this in your notes. You'll put this in your notes. We've got 8 areas we're going to cover today. We're going to crank along, if you will. Okay, 8 areas. Number 1, we're going to cover the first area is financial statement review. It's reviewing the financial statements themselves. Reviewing the financial statements themselves. Okay. Section number 2, if you'll put this down, I would write this somewhere in your notes. This is an outline of today's class. Section number 1, the 4 financial statements. Section number 2, a deeper dive into the income statement. Number 3, a deeper dive into the balance sheet. Number 4, quality of financial statements, including the notes to the financial statements. Section number 5, financial statement analysis, specifically the key ratios. Section number 5, financial statement analysis, specifically the key ratios. Section number 6, the LALOC model, LALOC, the LALOC model. It's an acronym. We'll cover it in a moment, later on. And it's the key ratios expanded. Section number 7. We have 5 advanced cash flow models. 5 advanced cash flow models. Section number 7, 5 advanced cash flow models. Section number 8, the Z-score and sustainable growth models. 2 different advanced key ratio models. The first is the Z-score, and the second is the sustainable growth model. 2 different advanced key ratio models. Okay, so we have 8 sections today. The first 4 is really advanced accounting / financial statements. The second 4 is mainly key ratio analysis. Is that a fair deal? Sometimes in these type of classes, we just jump right into the key ratios. We go to the second part really quick because as commercial credit analysts or loan officers, we're used to just jumping right in, looking at the key ratios, including the fifth and final of the LALOC, the C, cash flow, which we will do 3 foundational cash flow models as part of the first of the laylock model. But then when we go into the advanced, we'll extend into those 5 advanced cash flow models. Sometimes people just jump right in. They bypass the financial statement analysis. The problem with that, in my personal biased opinion, is we miss a huge amount of risk. Jonathan S. You don't mind S, do you? Jonathan R, you don't mind R, do you?
Nope.
Okay, just so we can distinguish. Otherwise, if I say Jonathan, it's like, oh, who's that? Which one? Okay, sometimes in these sessions, whether it's ground-based, virtual, or combined like today, I'll have 3 Marys or 3 Alices or 3 Bobs. I'm serious. And so that gets tricky. Bob 1, 2, 3, what have you. Okay, back to the story. We've got to do the financial analysis of the financial statements. If we don't, we miss half the story. There is so much risk in the financial statements. So many credit analysts, and I find this to be true, especially if you're newer to this discipline of commercial lending, is we just take the financials from the CFO/controller and or the CPA, and we just say, well, these are the financials, and I'm going to spread these numbers, or I'm going to do the key ratio analysis and the cash flow modeling, not realizing the risk of the underlying information. Does that make sense? By the way, how many of us actually spread the numbers? How many of us look at that? All the team, most of the class. Tricia, do you actually spread the numbers?
No, I don't spread the numbers. I do a review.
You do a review, but somebody else spreads them for you?
Correct. Yep.
Jonathan R., how about you?
I spread them.
You do spread them. Mike, how about you?
It depends on the loan size.
Okay. So you do spread some?
Yes. Yep.
Okay, good. So you're all familiar with it. Everybody? Josh, you don't spread them, but you're familiar with it? Of course. What software do you use, Ali? Credit Quest. Sawyer? Fiscal. Alicia?
No idea.
Baker Hill? Baker Hill? No problem. Josh?
Baker Hill.
Baker Hill. Those, we'll talk about that later on. There's Moody's, SageWorks, Baker Hill, and there's even a little known concept of Excel. Okay, so we'll come back to that. But most of you are familiar, or if not actually do this. Sawyer, when's the last time you spread a statement?
Last week.
Last week. Jonathan S?
Yesterday.
Yesterday. Anthony?
Friday.
Friday. Christian? Yesterday, of course. Ellie? Yesterday. Mike, when's the last time you spread a statement?
Last week.
Last week, good. So this is good. It's real time. Good. Let's move forward. Excellent. Okay. By the way, just another little housekeeping. We do have 3 quiz questions during the session today. Don't be alarmed. They're just real basic questions. I'll have you work the team here. The ground-based teams work together on those. They're real straightforward. They simply summarize the material we've just covered. Also, just before we forget, a little housekeeping. We will take 2 quick breaks in the morning, 2 quick breaks in the afternoon. We'll take about a half-hour lunch when food is served here, which is 11:45 Eastern time for those folks that are in Wisconsin. Tricia, help us remember, are you in Wisconsin? Or no, you're in Michigan, right?
Correct. I'm in Michigan.
So you're in Eastern time. Jonathan R., Central or Eastern time?
Central.
Central. And Mike, Mike, Central or Eastern?
Eastern.
Eastern. So everybody but Jonathan R. is in Eastern time. Okay, that makes it a little easier. Jonathan R., you'll bear with us if you would. So we keep on task, and I mentioned the times. Just if you'll just kind of compute that into, or convert that into Central time. It's great.
Yep.
And I'm on Pacific time, of course, because I'm based in Nevada. The entire state of Nevada is entirely in Pacific time, the same as California. People sometimes when they get to Vegas, they go, what time are we? Where are we at? Where are we at? And away we go. So it's good to be with each one of you. And that's kind of the schedule. If we clip along, Sawyer, Eastern time, we should get out by about 3:15. If we clip along, we do the work, and if we take quick breaks, is that a fair deal? Sometimes for the ground-based group, I say, let's take a quick break, and it's like the quick break is like 10 or 15, 20 minutes. Whoa, that's not a quick break. We clip along, we'll get done, because some of you have a drive to go. How many of us are guys who are going to go home tonight? Okay, excellent. How long? How long is the drive? About an hour and a half.
Hour and 10 minutes.
Hour and 10 minutes. Hour and 20 minutes.
5 minutes.
5 minutes. Don't go back to the office. Whoa. I've had people do that where we've got several people from the same lending team and one brave soul. I've got to get back and do some work this afternoon. You know what? And they're all going, are you crazy? No. When we're asked tomorrow, well, how long did that seminar go? Oh man, that guy kept us till about 5:15, 5:30 in the afternoon. Yeah, you bet. Okay, here we go. Let's rock and roll. Let's move forward if you would. Turn, if you will. We're on page number 3. Now we're in our first section, the financial statements themselves. Now we have the income statement, statement of retained earnings or owner's equity. We have the balance sheet. We have the statement of cash flows. If you'll add this to your notes, the steps, the major component parts of the income statement. By the way, what's another word for an income statement? P and what? P and L. Put in your notes. Christian hit it on the head. P and L, profit and loss. Ooh, don't say that to a CPA. I train the CPAs. I train also the attorneys. My 3 major groups are the bankers, the CPAs, and the attorneys, including I actually come to the state of Michigan and train the CPAs as well. Usually over in Troy in the Detroit area and or Grand Rapids. So train the CPAs. Oh, CPAs, what's that? A P&L? No, it's an income statement. What are the 3 main components? If you'll put this in your notes, revenue or sales minus expense gives us net income or net loss. Revenue or sales, same thing, minus expense gives us net income, net loss. Okay, now the income statement. What's another word for net income? Net profit. Same thing, right? Net profit. Retained earnings, statement of retained earnings. Put in your notes, beginning retained earnings plus net income or minus a loss minus distribution gives us ending retained earnings. Beginning retained earnings plus net income or minus a loss. You're going to have one or the other usually. You could have a break even, Anthony, in theory. And then minus distribution. If it's an S Corp or an LLC, it's a distribution. I put that in your notes. If it's a C corporation, which we're going to talk about, business entities tomorrow in the tax class extensively. If it's a C corporation, if it's a C Corp, it's called a dividend. If it's a sole proprietorship, it is called a withdrawal or draw for short. Pardon me, a withdrawal or draw for short. Okay, no matter how you cut it, Delisha is taking equity out of the business. Does that make sense? Okay. Balance sheet. What are the main components of the balance sheet? Assets equal liabilities plus owner's equity. Assets equal liabilities plus owner's equity. Okay. Why is it called the balance sheet? It must balance. Is that right? Statement of cash flows. There's 3 activities if you put them off to the side. cash flow in and out, cash flow in and out from operating or operations, operating, investing, and financing. Operating, investing, and financing. Operating, the normal operations of the business. The business will buy inventory, sell inventory. Let's use the example of Walmart. Allie, when's the last time you walked into a Walmart? A month ago, a week ago? Ooh, years ago. Noel? Week ago. You walk into Walmart, they buy billions of dollars of inventory and they're operating. Is that a source or a use of cash from Walmart's perspective? Is that a source of cash or a use of cash? Use of cash. Jonathan S. says a use of cash. And then they mark up those pieces of inventory, John, just a little bit. They put little tags and tell us how much markup on each product. You could have a product with a 5% markup sitting next to a product that has a 500% markup. Is that true? You'd never know it. That's part of the plan. They sell that inventory with the markup included. Is that a source or use of cash from Walmart's perspective? Source of cash, Josh says. I agree. That's operating. I put in your notes number 2, investing. Walmart, we talk about the second major category of the statement of cash flows, is investing. The source or use of cash, source coming to the company, use leaving the company, from buying and or selling fixed assets. From buying and or selling fixed assets. I put that in your notes, please. Second area of statement of cash flows. Now, does Walmart own most of its box stores that it operates? No, Christian, they don't own most of those stores. Those stores are owned by investment groups. Those are on 20, 25, 30-year leases. Does that make sense? But Walmart does own its distribution centers scattered around the country. Have any of you, Mike, have you ever seen a Walmart distribution center? Please.
I don't believe so.
Tricia, have you ever seen one?
I don't believe so.
Jonathan S? Never seen one. Noel? You've ever seen one, you'll never forget. We have one for whatever it's worth, an hour and a half from Las Vegas in a place called Southern Utah. Utah's only an hour and a half from Vegas. You've ever heard of Zion's National Park? We've all heard of Zion's National Park, one of the most popular in the country. Not far from the exit, where you exit the freeway, is a Walmart distribution center. It is huge. Let's say the distribution center cost $50 million. Let's say it costs $50 million. Is that a source of cash to Walmart or a use of cash? Christian? Use all the way. Okay, then after they build the distribution center, they say, wait a minute, there's 5 acres of land off to the side. There's 5 acres of land off to the side that we don't need. We'll sell it to a non-competitor, Josh. So what happens? They sell it to a non-competitor for $3 million. That extra land they don't need. When I say a non-competitor, somebody that's different type of business that they're in. That makes sense. They don't want the conflict. They sell it for $3 million. Is that a source or use of cash from Walmart's perspective? It is a source of cash, exactly. Third one is financing. Financing. Two forms of financing. Anthony, debt and equity, debt and equity. Walmart does have lines of credit. So your $1 billion, $5 billion or whatever, lines of credit. But most of the debt financing is in the form of a bond. I'd write that down. What is a bond? A bond is a long-term debt instrument. A long-term debt instrument. They'll issue $100 million in bond. Is that a source or use of cash from Walmart's perspective? Christian?
Source.
It is a source. And then every 6 months, they pay interest on the bond. Source or use of cash, Josh, from Walmart's perspective. It is used because they're paying out the interest on that bond. And then at the end of 10, 20, 30 years, they retire the bond. Usually they just refinance, but in theory, they pay off the bond, which is a use of cash to pay off the bond. Second one is debt and equity is the second one. Walmart will issue $100 million in new common stock. When they issue the $100 million, Jonathan S., source or use of cash from Walmart's perspective.
Source.
It is a source. And then every quarter they pay out a dividend to those shareholders. Is that true? Source or use of cash?
Use.
Use of cash. Good. Excellent. Jonathan, are any questions on the 4 basic financial statements?
No questions from me.
Got it. All right, let's roll. Here we go. Now, to highlight, if you'll turn with me to page number 4. Page number 4, here we go. There we go. Here is an example of Simpson Company. Now, we're going to see several case studies today, multiple different companies. Simpson Company is one of them. Our main company is not even in the notes. It's called ABC LLC. It is a small manufacturing firm located right outside of Lansing, Michigan. It is owned by Bob and Sue. The CFO was by the name of Jane, and their independent CPA is by the name of George. That's going to be our catch-all model. Is that a fair deal? In between that, we're going to have multiple in the PowerPoint presentation, other companies. But our catch-all today, tomorrow, and Friday is ABC LLC, Lansing, Michigan, right on the outskirts, small industrial park, owned by whom? Bob and Sue, imaginary couple, and they have an imaginary CFO / controller by the name of Jane. And Josh loves working with Jane because everything is timely, clean. She is good. She's on it. When he calls her, texts her, it's not like, I'll get that to you sometime in the next month or two. No, next morning it's there. Independent CPA is George. Fair deal? Now for this example, Simpson Company, we see the 3 activities. You've got a pen or a highlighter. Everybody, I would highlight operating, investing, financing. Pardon me, operating, investing, financing, the 3 areas. Look at the operating. Now, instead of Walmart, the big, huge corporation, Alec, you can see, wow, this is, of course, a small little business, kind of like you may even bank. Is that true? Company this size. Most of you would bank at your community bank. Look at this cash received from customers, $10,400. Anthony, source or use of cash?
Source.
That's a source. And then you can see they pay out cash for rent, cleaning, telephone, you bet. All those brackets, those are uses of cash. Fair deal? Second major area, investing, buying and/or selling fixed assets. In this case, they actually purchased, so it's a negative. Noel, is that a source or use of cash from Simpson Company's perspective is 1680. That is a use of cash. But if they had sold equipment for 1680, that would be what? A source. Good. Financing, investment by the stockholders, 60,000. Source and use of cash, deletion. Source all the way. Dividend to the shareholders, that's a use of $1,200. Pretty straightforward. Now, you see the 61,140? That's the combination of the three. I'd add this to your notes. That 61,140 must balance, you accounting majors, it must balance to the balance sheet cash position. And to be even more specific, that dollar amount, the 61,140, I put in your notes, must balance to the cash position on the balance sheet, which is even more specifically, the bank reconciliation or bank reconciled cash position, Sawyer. So it's not just the cash position on the balance sheet, but technically the cash position on the balance sheet where that cash account has been reconciled, the bank reconciliation, basically balancing the checkbook. Does that make sense? Okay, excellent. Questions on that? Pretty straightforward, the four big financial statements. Good. Moving to page number 5, here we go. Now, the financial statements do not just appear out of nowhere. It's a 10-step accounting cycle. Business transactions. Bob buys new tires for his truck. He spends $3,000 to $3,500 for all new 4 new tires. He gives the receipt to Jane, the CFO. She has to make a decision. I put this next to number 1, right next to business transaction. She has to make an executive decision. Is this a business transaction or is this a personal transaction? I'd write that down. This is huge because the way the judgment call, Delisha, that she makes will impact the books of the company. Would you agree?
Oh, yeah.
I put this in your notes. At first, she's tempted to say, oh, this is Bob's personal. And she's just about ready on number 2 to journalize this as a distribution to him because it's personal. And then she catches herself. She catches herself and she realizes, wait a minute. This truck is owned by the business. She can justify this as a true business expense. Does that make sense? So instead of journalizing against his distribution, it is journalized as a true vehicle expense category. Does that make sense? Debits, credits, debits, credits. Journal entries. Number 3, in the accounting process, at the end of the accounting period, like at the end of the month, we take all the cash accounts, whether they're debits and credits, and put them in a cash ledger account. All the accounts receivable entries into an account receivable account. All the account payable entries into an account payable account. Then we create what is called the trial balance. The ending balance from those ledger accounts we put into a form called a trial balance to make sure debits always equal, say it louder, Christian, credits all the way. Then under step number 5, Jane, the CFO controller, does adjusting entries. Off to the side of just adjusting entries. What is an example? Here's an example. Adjust for the balance of supplies in the company that's used up. I'd put that down. I'd write that down. Adjusting for supplies. Here's another adjusted entry. Adjusting the depreciation on the company's fixed assets. Adjusting the depreciation on the company's fixed assets. Here's another adjusted entry. If payroll is always on Friday, but the fiscal year end hits on Wednesday, Sawyer, she's got to adjust Monday, Tuesday, Wednesday from the first accounting period versus Thursday and Friday, Josh, from the second. Would you agree? Otherwise, the first accounting period is quote unquote messed up, and the second accounting period is messed up. Does that make sense? Tricia, does that make sense what we just said on the adjusted entries?
Yes, it does.
You bet. Number 6, adjusted trial balance. It's just a trial balance that's including the adjusting entries. Or a trial balance has been adjusted. Now we finally arrive at those 4 financial statements. Because once again, oh, and I'm telling you, I'm jumping ahead, but the biggest thing I have learned as being a contract CFO for numerous clients over the last multiple years since leaving the bank proper. I never left bank. I've had people sometimes ask me, well, do you consider yourself a banker? I'm more a banker today than when I was a banker. Because I'm more involved in the industry and I'm all over the country, whether it's physically and or virtually Zoom, if you will. Does that make sense? So I've had people say, few people say, well, you're not really a banker. Oh, yeah, I am, big time. Well, but the biggest issue is the underlying financials. If anything I've learned from the other side of the table from being a CFO is how much you do not see in the books of your borrowers and how much adjustments are made and things that happen, and it would curl your hair if you saw what I've seen. Does that make sense what I'm trying to say? Sawyer makes sense? LA makes sense? Does that make sense, Jonathan R?
Yes.
All the way. Thank you. 4 financial statements. So please, the whole gist of this first half of today's class is to realize, wait a minute. There is risk in the underlying financial statements. When I was on your side of the table, I remember one time I was a commercial lending team leader at one time, managed a team of lenders. And I was still an active lender at the time. Well, I remember I was backed up because I had all these administrative things going on. So I had to get through these new loan requests. First deal I touched, oh, the financials are messed up. The balance sheet doesn't balance. And then I put it back on my credenza, grab the next one, and those financials, because these are small borrowers, small to medium-sized privately held borrowers. They're not that swift. They're not the quality we'll talk about later in this section. And then I said, oh, forget that. That's James' responsibility. That's George, the independent CPA, and Grant and Lancey. So I grabbed the first file back and started looking at it, determining, hey, can we do this deal? Yeah, this looks like it's doable. I'll send this down to get the spreads done with the credit analyst pool or team of credit analysts. I'm thinking, then I caught myself, wait a minute. If the underlying financial statements are inaccurate, can your key ratio analysis be accurate, including cash flow? And the answer is no way. Do you agree?
Correct.
Mike, do you agree with that? Do you agree with that?
Yes.
Yes. Thank you. 4 financial statements. Then we journalize the adjusted entries from number 5, and then we close the books. In 9 and 10, we close the books. If you put in your notes, the 3 accounts that we close out, which means we zero out, assets, liabilities, and owners, pardon me. The 3 accounts we close out is revenue, expense, and dividends or distributions. The 3 accounts that we close out, or a fancy way of Noel saying we zero out, is revenue, expense, and distribution/dividends. Those are the 3 we zero. We say close, we don't throw them out. We don't close the account permanently, we just zero them out. The 3 that live on in the post-closing trial balance are the assets, liabilities, and owner's equity. Assets, liabilities, and owner's equity. assets, liabilities, and owner's equity or retained earnings. Okay, now, like the team leaders to spend just 2 minutes on this with your team. Out of the 10-step accounting cycle, what would your top 2 picks be for risk? In other words, think in terms of underlying financial statements. Think in terms of the process to get to number 7. And then to close out the books and get ready for the next cycle. What are your top 2 picks that you think, after you discuss it, that you think, wow, these 2 areas are the top 2 risk where errors, if they're made, will impact the financial statements, which are given to us, you know, from Jane and or George the CPA with a smile like, well, these are real and they may not be that accurate. What 2 steps of the 10-step accounting cycle would you as a commercial loan officer, you as a commercial credit analyst, you should be aware like, wow, there could be risk in this part of the process. And if it's done wrong, the output, which are the ending financial statements, are wrong. And that's what we're going to use in our second half today to do our key ratio analysis, including cash flow. Does that make sense? Go ahead, spend just a couple minutes. Team number 4, if you'll work on this together or individually, and I'll call on you as well. So take just a couple of minutes on this.
Yeah, I mean, you can't do it up to the financial statement and all of that is part of it, right? But it's not super strong for wrong decision. Whether it's personal or just-
Team leader Sawyer.
And then again.
Hey, keep going. Team leaders deletion. Wait.
Oh, you were. They are.
But you had
Yeah.
already. Where did you find it? Which way did you go fishing?
I'm an hour and a half, that's at the very bottom. Well, 2 hours. Yeah. My husband has, yeah, I'm right at the border of Indiana.
It's right down this way. Wow. How far to here? Hour and a half?
Hour, 10 minutes.
That's
11 minutes right there.
Take just another half a minute on this.
Yeah, I would agree.
Okay, here we go. Let's start with team number 4. We will start with Trisha. Trisha, can you give us your top 2 picks, please?
My top 2 picks are adjusting entries and journal entries, because some of that is just not black and white. It's their perception,
Yeah.
which could falsify or inflate data based on how they want to use
I
it.
love that word, falsified. Whoa, I like that word, inflate as well. Adjusting entries number 5 and number 2 journal entries. Good. And I do agree. Oh, huge. Deletion. Team, thank you. Team number 3. Rotate the other way.
So I think we were thinking along the same lines. We had 1 and 5, but 1.
They said
says
1 and
decision.
5. 1 flows into 2.
Yep.
And number 5. Excellent. Team number 2, Sawyer.
We also picked number 5 and number 2.
Number 5 and number 2. Boy, same. Team number 1, Josh.
5 and 2.
5 and 2 all the way. Excellent. Excellent. I agree with each of the teams. There is so much risk, especially in these adjusted entries. I'm going to say it straight out. When you work with the Janes of the world as credit analysts, as commercial loan officers, and when you ask her, well, how often do you do your adjusted entries? Oh, when I get around to that, sometimes once a quarter, sometimes once every 6 months, sometimes, and she admits to Noel off the record, well, sometimes once a year. But then she is presenting to you, Noel, the updated financial statements every quarter. And you're thinking in the back of your mind, how accurate are these numbers? Not very. And then you may say, well, what about even year end? The year end, especially if they're company prepared financial statements, right? Jonathan S, right? Right, Jonathan R, is that true?
Yeah.
Yes. Year end, you just kind of wonder, how accurate is this reporting? We'll talk quality in just a few minutes. Turn the page. That was excellent everyone. All teams, that was excellent. Let's turn forward. Page number 6, here we go. Now, income statement, dive deeper dive. And then the balance sheet. Okay. Income statement, revenue expense recognition. You remember from your accounting classes, what is the difference between an accrual basis versus cash basis? By definition, accrual basis is we recognize, I put this in your notes, please, accrual basis. We recognize the revenue in the period in which it is earned. We recognize the expense in the period which it is incurred, irregardless of cash coming to us or leaving us. We recognize the revenue in the period which it's earned. We recognize the expense in the period which it is incurred, irregardless of cash coming to the business or leaving the business. Cash basis is just the opposite. We only recognize the revenue, well, when the company receives the cash. We only recognize the expense when they pay out the cash. Small little business is on a cash basis usually, but more sophisticated accrual basis. Although when we get to our cash basis cash flow, you're going to hear me talk out of the other side of the mouth saying, well, instead of that accrual based EBITDA inflated cash flow, which Jonathan S did just yesterday, right? EBITDA, we're talking cash basis, more accurate. Whoa, FIFO, LIFO. I always think in terms of dog food. They almost sound like dog food. What is FIFO? Everybody in unison. What is FIFO? First?
In first
Out. Good. Excellent. What is LIFO? Trisha, what's LIFO? Last in?
First out.
Good. Excellent. What about FIFO? This is inventory costing. FIFO flows with the normal flow of the inventory. The company buys inventory in January. They sell inventory, Gally, in January, February, March. They buy inventory in March. They sell it March, April, May. It flows with the normal flow. LIFO, we assign the cost of the last inventory purchased in December as if it was the first inventory sold in January. It's simply an assignment of the cost. Has nothing to do with the physical flow of the inventory. If you have inventory rising over time, from January cost, from January to December, you're using the higher December costing out as if it's January, Josh. Under LIFO, you have somewhat inflated the cost of that inventory. You have accelerated, if you will, or increased cost of goods sold, lowers the gross profit of the business, lowers the net profit of the business, lowers the tax bill to the IRS. Legitimate process. IRS, though, if the company's on LIFO, they're not going to let you flip back and forth depending on what happens to the cost of the inventory. Usually once you're on it, boy, you're in it for 10 years plus. Moving right along. I will, please, I beg of you, each of you, Mike, everybody, put in your notes next to that concept of FIFO, LIFO in particular. If you have a company that's inventory based, Sawyer, and they're under LIFO, the positive is you could have some hidden equity within the inventory sitting on the balance sheet, jumping from the income statement to the balance sheet. The reason why, Noel, is because the inventory, if they're essentially pre-expensing it quicker, that's from an accounting perspective, but the physical inventory in their warehouse relative to the market could actually be higher. Does that make sense? Josh, makes sense? Makes sense? Felicia? Okay. What about operating expense versus improvement? Whoa, we're going to talk about this tomorrow in the tax class. Whoa, here we go. Jane, the CFO, approaches you. And by the way, we're going to shift Jane back to the sharp Jane that she is, the sharp CFO she is here in Lansing. Repair versus improvement. Repair versus improvement. Okay. She comes to you and she says, well, I talked to Bob and Sue. We have some urgent needs to repair our roof to our building that you financed several years ago. And I've done my calculation. You always told me your bank will go up to 75 or 80%, even 80% loan to value. She doesn't use LTV, we do, but she says loan to value. We need a couple $100,000 out. What do we call that from a commercial lending perspective? A cash out refi. You put that in your notes. A cash out refi. A cash out refi. Okay. She just says we need 200,000 out of the building. But she says we're going to put it right back into the building. By the way, on an ancillary note, Christian, some banks will say, fine, if they do it, they'll run the 200,000 through their construction voucher system. Does that make sense? Because they want to make sure, Jonathan S., they want to make sure that the money gets into the building. Other banks say, no, we trust Bob and Sue. We're not going to mess with that. Allie is the chief credit officer of the community bank. She says, we don't care about that. Here you go, Bob and Sue. Here you go, Jane. Pardon me, here's 200,000. You manage it. We're not going to touch it. Make sense? That's an ancillary concept. Now back to the story. From an accounting perspective on the income statement, are they going to count that 200,000 as a repair where they expense it? Or are they going to depreciate it, which is tied into tomorrow's theme of the thing called tax? So we'll see this again, but from the tax side, same concept. Depends. Depends on who. George, the CPA. Independent CPA right here in town. Generally, his position, whoever that CPA is, they're going to make the call. If they expense it, it's called a repair. 200,000 is going to be expensed to the income statement. Is that true? If they capitalize it and they show it as an improvement, if you put this in your notes from a tax perspective, 39-year depreciation, 39-year write-off, 39 years. We'll come back to that tomorrow. It's up to George using. Bottom line. Ultimate call on these type of level of decision making technically is Bob and Sue, the owners. But from a technical standpoint, meaning from an accounting / tax standpoint, they will defer to who? George, the CPA. Including Jane will defer to who? George, the CPA. Questions on that, Jonathan, or any questions on part C?
Nope.
Got it. Now, what about depreciation expense? Income statement. From the books, meaning the financial statement versus the tax. We'll start with the books. By the way, you'll see the that we're doing some tax today, but mainly financial statement source document today with some tax. Tomorrow in the tax class, you'll see mainly tax with a little bit of financial statement source document. Does that make sense? Which is natural. We need to tie the two together, and then we'll tie the subject matter on Friday together even more. Does that make sense? We'll tie it all together on Friday to summarize the 3-day session. Straight line. Woo, straight line. If you have a delivery van, costs $20,000 less than the salvage value, it's depreciated. Typically, I'd put in your notes over a 5-year period. 5-year period. That'd be $4,000 each year. Is that true? I'd write that down. 5-year period, $4,000 each year. Units of production or activity depends on how many miles driven. So it's so many cents, like 35 or 50 cents per mile driven. Double declining balance from the book standpoint. If you'll add this to your notes, Sawyer, is 2 times the straight line. So Mike, if the straight line is 20% per year, because it's over a 5-year period, 20%, right? Every year for 5 years is 100%. Double declining balance, Mike, is 2 times 20% or 40% accelerated. Any questions on that, Mike?
No.
Got it. Okay, now what about the tax side? 3 forms of tax, which we will go in depth on tomorrow. We'll keep it light today. Makers. Makers is the most common. It stands for Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. MACRS. Typically 5-year on equipment. It's already there. Don't even have to think about it. It's in the system, so to speak. Okay, here we go. What about section 179? Whoa. This allows in the tax code, ABC LLC, our generic company we're using today, right here in Lansing, small industrial park, small manufacturer, they buy a piece of equipment. It allows them to write off the entire asset in 1 year. Okay, there are limitations. If you put in your notes for 22, the limitation is this: 1,080,000 per year for the year. 1,080,000, not 1.8 million, but 1,080,000. As long as the company has not purchased or does not purchase more than $2.7 million in total equipment for the year. 1,080,000 can be written off. As long as they don't purchase more than 2.7 million. We're going to go in depth on this tomorrow. This is huge tax strategy. What if they bought only $750,000 worth of equipment, ABC LLC, and they use section 179 depreciation? They could write it all off. It's below 1,080,000 and it's not more than 2.7 million, right? What about bonus, the third form of depreciation? It's called bonus or special depreciation. I put the word special. Used to be only 50%. Now, in the current tax code, it's 100%. 100%. Does that make sense? Good. Excellent. Come back to that as well extensively tomorrow on form 4562 tomorrow in the tax code. Now, before we leave this, most all commercial underwriters will add back makers. Almost everybody does. Who? Most everybody will not add back bonus. It's too aggressive. Not from a tax standpoint, it's legitimate, but from a commercial lending standpoint, too aggressive. How about section 179? You'll add this to your notes. This is pretty much a 60-40 split. A 60-40 split. 60% currently of all commercial lenders, Anthony, do not add back section 179. They're using the tax return as the source document, our major theme tomorrow. 40% do. It's a controversy within our industry, has been for decades. 40% yes, 60% no. We'll hold that thought for tomorrow. Why 60% though? So why would they say no, we're not going to add it back in? We don't add back fuel expense, we don't add back salary expense, those are true cash outlays. If they're expensing that equipment, why are we going to add it back in? Here are two arguments to favor the 40% people. Number one, whose cash was it to buy the equipment? Josh, the majority of the cash came from the bank loan. You go 80, 90, 100% loan to value, LTV, most of the cash came from the bank. So why don't we add it back in? Number two, what if ABC LLC only buys equipment once every 5 or 6 years? Sawyer is called a non-recurring event. Does that make sense? So why don't we add it back in? We'll come back to that tomorrow more extensively because we'll see the actual form, tax form. Everybody split, nobody, essentially. Never say never, but usually that's how it runs. I'm talking about from a commercial lending standpoint. What is amortization? Amortization is like depreciation, but for an intangible asset, goodwill, patent, franchise fee. What about depletion? It's like depreciation. What type of asset, Christian? You remember? What type of asset? Sawyer.
Natural resource.
Whoa, natural resource. He hit it. Timber, oil, natural gas. You have a little bit of that in the state of Michigan. Is that true? Natural resources. Do we have natural resources in Nevada? It's desert. It's barren. You know, one of our biggest natural resources? Huge. Gold. We are the largest gold producing state out of the 50 states by far. We're like number 4 in the entire world as an entity, the state of Nevada. Our state theme is the silver state because of the silver mines back in the 1800s. But that's 1800s. Today, we produce or mine more gold than any other state, hands down. You could probably add all 49 states together. We do more than that. Seriously. Questions. Do we add back makers? Do we add back this depreciation book? Yes. Makers, yes. Possibly section 179. Bonus or special, no. Do we add back amortization or EBITDA cash flow? Yes. Depletion? Yes. We'll see that in a moment. Let's roll forward. Page number 7. Okay, here we go. Balance sheet. We'll start into this for just a moment, then we'll take our first break in the morning. How many of us receive AR aging reports? Mike, do you get AR aging reports ever?
Yes, I do.
Good. Tricia, do you ever get AR aging reports?
Yes.
Good. This is for you. This is for everybody. Everybody raise their hands. Whoa. Think in terms of collectability. If you will highlight this little saying, next time you get an AR agent report, when you look at those receivables, consider in your mind you are looking at ABC LLC's loans. What? Yes. When they give terms, on those receivables, 30, 45, 60-day terms, they have created a loan. Alicia, does that make sense? Jonathan R., does that make sense? They've given a loan.
Yep.
Yes, because they've given terms. So the next time you get or receive, Ellie, an accounts receivable agent report, think in the back of your mind, how good of a lender is ABC LLC? A lender? No, we're the lender. Oh yeah, we're a lender, but they're a lender too. Essentially, what I'm saying is the vast majority of your commercial borrowers, Josh, you're lending to them, they're lending to their clients. Does that make sense? And we take a UCC1 filing on those receivables. Is that true? What are those receivables? That's their loans. What does UCC stand for, Sawyer? Uniform teams. You can help team members.
Commercial code.
Uniform Commercial Code filing 1. Is that true? Yes. How many of us have ever touched a UCC1? Good, look at that. Anthony, when's the last time you touched a UCC1?
A long time ago.
Whoa!
At least a year and a half. Probably.
Whoa! We'll talk about that further on the CNI class Friday morning. You bet. Allowance for doubtful accounts versus direct charge-off. I put in your notes, most of your borrowers by far use the direct charge-off or direct write-off. I put that in your notes. The vast majority of your borrowers use the direct charge-off or write-off method. That means when the receivable's dead, they just wait till it's dead. And George, the independent CPA, calls Jane and says it's time to charge that off. Is that true, Jonathan S.?
Yes.
Yes. So you can have the slang term, Jonathan S., when you get that AR agent report, you can have actually a lot of dead wood in the middle of it. Is that true? Otherwise known as a sleeper cell. What is a sleeper cell? In the spy world, Noelle has lived in her town in Michigan for 20 years. How long you lived there? More?
No.
Let's say you've lived in that town for 20 years. She is a pillar in the community. No one knows until it comes out years and years later. She is a communist spy. She is a sleeper cell in the spy world. How many of us have ever seen a spy movie? Like James Bond or one of them? Yes. She's a sleeper cell. She is a receivable that all of a sudden out of the blue gets charged off. Like, what? She's this mild-mannered banker in her town in Michigan. And she's not. She is a communist spy. Allowance for doubtful accounts, that's more sophisticated. But even your larger commercial borrowers usually do not use that. The bank does. The reason why? Josh Bank is a lending institution. He has to do this. Does that make sense? He's got to have the reserves, if you will. In the bank, we call it a loan loss reserve, or officially today, an ALLL, allowance for loan and lease loss reserve. Anthony, do you work on that in the bank? Oh, he works on this. On the call report?
Not on the call report with the CECL model and the ALLL model.
Whoa! ALLL and the CECL, whoa! Hot tip, look at that. Percentage of sales, percentage of receivables. We charge off 1% usually of our sales. That's how much the company would reserve. Or the more accurate, in my opinion, is the percentage of the receivables. Does that make sense? That's actually closer to what you do when you lend. How many of us use a borrowing-based certificate? Look at that. Friday morning, we will top BBC. No, not British Broadcasting Corporation. No. BBC, borrowing-based certificate in this room. All the way, Josh. Yes. All the way. We'll stop right there. We come back, we'll talk about the other side of the balance sheet, the liability side. Before we take our break, need the team leaders spend 1 minute on this? Team number 4, spend 1 minute on this. Any questions so far? Any questions so far? Talk amongst yourselves. Any questions? Okay, we'll start with team number 2. Sawyer, any questions?
I don't believe we have any questions.
No questions. Delisha.
No questions.
Tricia, any question?
Nope.
No questions. Josh, rock and roll. Let's take a quick break. We'll come on back.
You certainly can.
I was gonna sit over there and I thought, I'll take our breaks all through the day. I'm thinking, no, I think I'll just move my chair over here, if that makes sense, you know.
Yeah. I appreciate your energy.
Good, thank you.
Right. Or were you at Nicolay?
I was at MBank.
That's where he was.
I was not in the commercial department though.
We were together, which class?
Are you talking about that one?
Lauren, that's it.
But where was-
I used to work with Adam at Range.
Okay, it was
Okay.
here?
So when
Oh,
he
you
was
were
at
at
Range,
Range.
yeah, I was at Range when Adam.
Now,
was
where,
the- when
what
Adam
part of Michigan are you
transferred over.
based?
Oh,
I left.
I live in Lansing, but.
I was there.
Chelsea.
You live in Marquette?
Yeah, so I'm from Marquette.
oh, you are?
Yeah, and I went to school in Hope.
So you live here, but you commute?
He was,
An
you might know
hour?
him through Petro, his last name.
Yep.
Yeah, it's my
Okay.
grandpa's Tony.
And wait,
Petro.
who,
Okay.
So.
who in the
but-
class, or do you work, do you
So
work with
that
anybody
was,
here?
Not the first 2 days.
was
I
there,
got Lester coming in for
months,
the
just didn't
Friday.
know what
Oh, right on.
At Range.
So
Yeah.
tomorrow we'll have
So,
other people,
I
some
left
people, I
came
know
back here
Noelle
to
won't be able to come,
Okay.
she's gonna try to see if she
School in
can
Hope,
add.
worked up there. I came
And-
for a
But we'll
little
have
while.
more.
Oh, nice.
Yeah, and then we'll have a different mixture
I worked for
tomorrow and then even on
Did you?
Friday.
Yeah, I did.
Um,
I was a loan ops.
I know Ally
Basically
said
intern,
that,
and then I was the
uh,
credit collection.
she
agent for a
will not be
while.
here
Okay.
tomorrow,
So
but
I
she'll be
did
back
that
Friday,
too.
so, and that happens, the best,
Nice.
the best because
Oh, that's
you
cool.
can see guys together.
Yeah.
Yeah.
Yes, to do all.
Yeah, I'm excited.
I never got to work. I think
This is
Adam's.
all-
Well, and a lot of
Like, I know some of it, but most of it
Yeah.
is very new to me,
Yeah,
so.
well, and a lot
He
of
was an
times-
analyst, right?
Yep.
Yeah. He left well before I got into the first department.
Yeah, he left, I think after the merger was announced.
So they.
Yeah.
And when they started just.
Basically,
Oh, that's what it was. When they shut down that office
Yeah.
by,
I'll have people.
McDonald's there,
First
that's when.
Not the second,
That's
but
when he was on that office.
First. meeting.
So, yeah, they really,
First
well,
and second.
Yeah, they did not make a lot of friends.
I won't even,
Second,
but
third,
the backstory to that is that was never.
Yeah,
But
because you have to make sure.
most of this, yeah, most,
It
and that's
was
what
the
we'll read
the way they portrayed it,
Because
the
I-
bank leadership portrayed it to
We'll have
employees was that
Yeah.
if you weren't willing to move to Green Bay, that you weren't gonna have a job. And that was so far from the truth.
It's
And
unfortunate.
MBank's leadership, who I was never.
Yeah.
So
leadership.
There's an exception, you know, main exception.
The way they perceive that.
Yeah, that's how mine was.
Professional.
Yeah.
And
We're
it's
gonna go on.
Yeah, yeah, oh, yeah, we'll say, when they look at it, they go.
It is.
"Well,
There's so many
in all
conflicting
times,
pieces.
all times.
Yeah,
You
makes
believe
sense.
You almost have to believe the
Logically.
worst case scenario.
Yep.
Because I mean, it's the best thing that we do for your family, right?
Right.
It's the safest route, and so I
You might
can't
have-
blame them for leaving.
Oh, no.
Right, it's tough.
Never. I mean,
Well, we-
right?
we're-
Yeah,
Where,
no,
where
I
you
mean, that's
based?
basically what it is.
And that's the tough.
I
Did
knew I
he-
would be safe
Would he have gone to Green Bay
before this.
or Madison? One of
I
those.
was a sales
Yeah,
rep.
then I've had to
They're
bear.
gonna
Yeah,
get
you-
rid of it.
Yeah, because,
That's why you're
because
there.
I go,
knew
yeah,
that
because I go
safe,
to, I
But
go to
others,
Madison and
I-
Green Bay.
100%.
And yeah, you
never,
look
ever
familiar, but it's.
That's
believe
great.
it.
I
Now,
love
where-
it.
where is
And the way, like I said, that it was delivered to
Okay.
us was really
I figured
unfortunate.
it,
And
because we get asked all
I
the
spent
time.
3
Yeah.
months.
Yeah, what, how
You don't
long,
want
how much
to-
difference?
He's 25.
Sales pro.
Yeah, I was gonna say.
No, I thought completely changed now.
Okay.
For a while, we were cash heavy.
Yeah, well, and that's why.
Yeah.
We know,
were super cash heavy. Now,
Yeah,
I don't think when they came to the UP, they really understood how much.
Okay,
how
and
financing we were gonna
we've
do
been together in classes or no?
Yes.
It's
Okay.
key, right? I mean,
Ally,
it
we've
might be
never
property
been
that's
in
not
class
conform
of
to the
that.
secondary market
Oh, yeah.
or it doesn't.
Because sometimes,
So,
especially with
you know,
COVID,
we're gonna,
I've had people
we have to
that
be
are
pretty
like,
creative up there.
they'll
I
walk
don't
in and
think
say,
they
hey, how
take
you
into
doing? I'm thinking,
consideration
do I
how
know
much,
you?
you
No,
know,
you-
is lending.
we've been together for three
Now they want
classes,
to
and then I
buy.
realized.
Yeah, exactly.
Oh,
And it's
virtual.
not necessarily just.
No, wait.
dry, like,
sorry, have we been in class
deposit
together?
growth or anything like that. It's
Ever?
it's
virtual?
virtual as a
Okay.
bank. You know, our-
Because
our
some,
whole structure
it's
is
hard.
individual.
COVID
It's
really
how's-
messed
how's your bank,
on the
how's
brain.
your branch, like, how's your market?
Yeah.
That makes sense.
Oh,
Yeah.
that is so
No,
true.
it-
And there,
you know,
it's coming
I
out,
will
and you knew it was gonna come out also.
like you said, we gotta know
They,
it's
they're
a little bit
learn,
nerve-wracking,
what's the term?
but
They're
I
not
will say
disabled,
that
they're
everything
learning
that I've been
like
told
stunted.
from Nicola has come to fruition.
Is that what it is?
And
Okay.
that's all I can ask.
Oh, yeah.
And, you know, that's all I can ask, especially.
They, we're in during COVID, and now they have to unlearn that, just the way that should.
Yeah. Yeah, it's a real mind trip in their, especially in their learning progression. Especially if they were like in kindergarten, first grade, second grade,
Are they really?
some of the foundational, wow. It's a real mind trip on the entire American population with certain ages.
Yeah.
What's gonna be interesting
On down
is
state.
10 years from now, 20 years from now, that's gonna be interesting. You know what I mean? It's gonna be a real interesting play, 10, 20 years, 10 years from now, these kids are now like, okay, first grade, they're like juniors, seniors in high school, and then into college. In other words, circle, how we're using
It's so
pandemic,
sad.
you know, that's what
Be
we
crazy, got Baker's
Yeah.
Corner down there.
We'll get started in just a moment.
All those.
Train kids. It's a mind.
Not as with like Zoom virtual or like even
Oh,
connect with the subject of
Oh,
the.
this, we're off the record. I teach both ground-based and online. Of course, I do webinars every day if I'm not on the road. And I'm doing now more webinars than ground-based, although I'm starting to get back out. What I have found though. is, Like our clients' classes, they're valuable.
Yeah.
We're doing with people and like we're doing here.
The interaction.
And this is interaction. I mean, they're interacting, so at least they're interacting, but some of my, most of my online college teachers has been over the years, no live interaction. It's not like a Zoom program, you know what I mean? So there's no facial, I mean, here we can see, you know, there's, you know, you can see them. Oh, yeah, it's. If I was an employer, I would, someone says, well, my whole degree was online. No interaction with live people. We have a daughter that's in our master's program with a social work, but it's a live Zoom 3-hour meeting every Thursday. Her time, 5:30 to 8:30. So it's a live interaction once a week, and then in between, you're on your own, or they do collaborate. But at least, and they have to be on camera those 3 hours. So that to me is, I told her that's a lot better than if it's just a pure online masters, you know. Because she's gotten to know the faces, and when she does the graduation, she'll go to Chicago to her program, you know, and graduate, meet the people. Okay, let's go ahead and get started. We are back rolling. Tricia, you're back with us, we can see. Jonathan R. and Micah, you're back with us.
I am, yes.
Excellent. And Mike, I know you may not have if you have the, Mike, if you have your visual, if you could show us that. If not, that's fine. We can hear you loud and clear. You bet. We were just talking just briefly, Noel and I, talking about the importance of the visual, but at least we can hear you. But if you do have that, that'd be great. Okay, if there's anyone else, it looks like there's someone else on. There's someone else, if you can chime in and let us know who's there. It may be Cindy, but I'm not sure. Okay, here we go. We're gonna continue. Accounts payable side of the balance sheet, the other side of the balance sheet. The timing is huge. We're gonna see a model in our key ratio section later on today that says, Sawyer, if you're the company, stretch those payables out as much as you can, as long as you do not get put on COD. Christian, what's COD? Cash on? What's COD? Jonathan S?
Delivery.
Put in your notes, delivery or demand. One of the two. Cash on demand, cash on delivery. We do not want to get put on that. Is that true? The company does not. Whoa, capital versus operating lease. Some leases. What's a lease versus a loan? What's a lease versus a loan? We'll talk about it in the CNI section on Friday morning. What's a lease? A lease is where they simply just rent the equipment. Who owns the equipment? The bank does, technically. Do we want it? No. No. But a lease, you have a lessor and a lessee. You don't have a lender and a borrower. The bank is the lessor. The borrower is the lessee. Some leases are put on the balance sheet. They are called capital leases. Capital leases. You see the equipment on the asset side of the balance sheet, Josh. You see the capital lease on the liability side or debt side of the balance sheet. Versus an operating lease is simply just, oh, they rented the backhoe for a week or 2 weeks, or they rented this other piece of equipment. They just expense it off. Their intention is to never eventually own it. Whereas a capital lease, when they make that last payment at the end of 5 years, the title transfers from Sawyer Bank to ABC LLC, the manufacturer. Does that make sense? Cool. Turn forward, if you will. Still in the balance sheet. Still in the balance sheet, page number 8. Page number 8 in the balance sheet. Equity section of the balance sheet. Assets equal liabilities plus owner's equity. If it's a corporation, you could have 2 forms of stock, common versus preferred. Team leaders, lead a 1-minute discussion, please. What are the 2 benefits? Ooh, going to reach back in the back of the brain in your accounting classes and or other background that you have as lenders. What are the 2 preferred benefits of the preferred stockholders? The lords and ladies. They are the blue bloods, Allie. They're the blue bloods. By the way, it was Princess Diana Blue Blood. Just celebrated her 25th death. 25 years. No, seriously. You saw the news last week. Boy, it was all over. Celebrating, it was 25 years since she passed. Celebrating her life. Not celebrating her death, but I mean honoring her life. Honoring her life. 25 years since she passed. Was she a blue blood? Yes or no? It's a trick question. Sawyer?
No.
You were right on. She was a lady with a title. That's different. That's a lower level than a blue blood. Did the royal family like it that she was not a true blue blood? Yes. Yes. Because it's called diversifying the gene pool. I'm serious as a heart attack. The preferred, the lords and ladies, the royals, they suffer from a blood disorder. What is it called? It's called bleeders. It's called hemophilia. Is that true? By the way, is Kate, who's Kate married to? Prince what? William. Is she a blue blood? Oh, no. Is she a lady with the title? No. She's even lower. She's a commoner. She's that common stock commoner. Is the Royals, did they dig her? Yes. Better for the gene pool. Get away. Why? Because all those royal, by the way. What's the Queen's name? Queen of England? What's her name? What's her husband's name? He passed away a couple of years ago. What's his name? Prince what? Philip. What do you mean by gene pool? Prince Philip and Queen Elizabeth were husband and wife. Is that true? They were a husband and wife. Is that true?
Yeah.
They were also third cousins on one side of the family. They were also second cousins on the other side of the family. They were kissing cousins. Commoners versus preferred. Are you a commoner? Are you a commoner or are you preferred? Two benefits from being a common stockholder. Go ahead as a team, work on this, take a minute or two. Team number 4, I'll ask you as well. What are the two benefits of the preferred stockholders, the lords and ladies of the world of stock? I'll start with team number 3 and rotate. Company goes under liquidation, they get paid before those commoners, those peons. What is the benefit? What are two benefits of the preferred stockholder over the common stockholder? Preferred stockholder versus common. Did you get the other one? Okay, they think so. Did you get the 2? No problem. Well, wait just a minute. Wait just a minute. Wait just a minute. Wait just a minute. Okay. Okay, here we go. We're going to start with Mike. Mike, what is one benefit of the preferred stockholders over those commoners?
Well, I'm not entirely sure, but in the event of some sort of liquidation, is there a higher claim on assets?
Yes, he hit it right on the head. Mike, that's excellent. A preferred stockholder, if there's a liquidation of the company, they get paid first before those commoners. Thank you. Team number 3, Delisha. Any others? Can you name the second one? If there's only so much cash to go around to pay out a dividend, preferred stockholders get paid first and then commoners. You are right on the money. So if there's only so much cash to be paid out, a preferred stockholder gets paid the dividend first over the common. But team number 2 pointed something out with common. The big benefit the common stockholders have that the preferred do not is that the common stockholders have the right to vote the issues of the corporation. Does that make sense? So it's not like they're completely left out. Wow. Moving right along. Excellent teams. Common stock, S corporation, only one form of stock, common. LLC partnership capital. Whoa, related mainly to publicly traded corporations, but could be related, especially this one, to your privately held small business you're working with, especially if it's a nonprofit. What is treasury stock? If you put in your notes, treasury stock, like Microsoft, they'll buy $500 million worth of their own stock. Microsoft will go into the open market and buy $500 million worth of stock. And they will put it, it used to be years ago, the actual physical certificates were valuable, the piece of paper. Today, it's all virtual. And Josh, they would take those pieces of paper, and they're known as stock certificates, and they would store them in the vault or the treasury of the corporation. Does that make sense? That's where the title treasury stock comes from. Today, it's all virtual. It's all virtual. Come on, Anthony, it's virtual. It's modern. They will hold that stock, Jonathan S., for 6 months. And then what do, Jonathan R.? They sell the stock and make profit on their own stock. They will buy their own stock back in the market. They will put it in their treasury or store it for 6 months. And then they sell the stock to make money on their own stock. The Biden administration, no less than 3 weeks ago from right now, came out and said, well, we're going to try to stop that. By the way, today, tomorrow, and Friday, I am politically neutral. Just to clarify, Josh, in all my teaching, especially tomorrow, tax. Why? Because the tax code is politically laced. I do not side with the Democrats, the Republicans, or the independents, or even the Greenpeace Party, or whoever. I am neutral. Allie? Neutral. Neutral. You'll hear me say this tomorrow. You'll hear me say this on Friday. I am politically neutral. But less than 3 weeks ago, 2.5 weeks ago from right now, Biden administration came out and said, we're going to try to stop these corporations doing that for whatever reason. Moving right along. What is a 2-for-1 stock split? What is that, Anthony?
You get 2 shares of the stock for every one you own.
Whoa, he hit it on the head. You get 2 shares. You own 1 share of stock worth $10. There's a 2-for-1 stock split. Now you own 2 shares worth how much a piece? $5. Mathematically, it's the same $10. But what's the goal with the 2-for-1 stock split? The goal is to get momentum of the stock. And overnight, those shares will go up in the open market to where now you have 2 shares worth $10 a piece. Now you got $20, right? 2-for-1. 2-for-1 is a very common stock split mathematical. What about retained earnings? I put in your notes, restrictions. I add that to your notes. Big, large publicly traded corporations, they will have restrictions on their retained earnings, sometimes through the bond offering. But Noel Banks, a small local nonprofit, a charity in her bank. They lend to it on the facility and other loans, equipment and so forth, financing. Sometimes you'll see this, a small nonprofit where they will have restriction on the retained earnings, which really means what? You think of the balance sheet, assets equal liabilities plus owner's equity. Well, if your owner's equity is restricted to retained earnings, really what you're doing is you're restricting the cash on the other side of the balance sheet. Does that make sense? I'd write that down. When you restrict retained earnings on the one side of the balance sheet, what are you really saying, Josh? You're restricting the cash on the other side of the balance sheet. Because typically you can't say, well, we're going to restrict their cash. Because you can't strap a company's hands from using this cash. But you can quietly restrict the retained earnings side, which really means you're restricting the cash. Does that make sense? Excellent. Let's move forward. Now, page number 9. Quality, our next section, quality of financial statements. Whoa, let's start from the bottom. B3, circle company prepared. And then put in your notes, QuickBooks. Tricia, do you ever see QuickBook financial statements?
Yes, I do.
Do you see them every day?
Yes, I do.
Do they drive you crazy sometimes?
Perhaps.
Oftentimes the balance sheet doesn't balance. But some commercial lenders nationwide, and if you would add this to your notes, this is huge. This is a big mistake in my biased opinion. Some commercial lenders will bash QuickBooks. What do you mean by bash QuickBooks? They say, well, this is low-level accounting software. This is rinky-dink. That is a misnomer, Ally. QuickBooks is state-of-the-art software. Most all CPA humans in America are extremely in tune with QuickBooks. Does that make sense what I just said? I mentioned I trained the CPAs in this beautiful state of Michigan, seriously, over the years. And they are, almost every one of them is involved in QuickBooks. They are total QuickBooks specialists. It is not the software that we need to be concerned with, Jonathan S. It is the user. He hit it. I put that in your notes. It's the user, Jonathan R. It's the user. It's Jane. Alicia, do we trust Jane's numbers?
That's on Jane.
Depends on the Jane, the actual Jane. We make believe today, tomorrow and Friday that, oh, she's sharp. But sometimes the Janes of the world are not that sharp. Is that true?
Yes.
Moving right along, company prepared. How many of us raise the hands, including those in the team number 4? Raise your hands if the majority of the financial statements you receive from your commercial borrowers are company prepared. Raise the hands. Look at that. Look at that. Look at that. Thank you, Tricia. Thank you. Most of you, good. What about CPA compiled or compilation? It's a higher level. If you'll add this to your notes, it's basically Jane emails George, the independent CPA, the QuickBooks. And George takes those financials, slaps them into his form, and issues the financials with a big disclaimer. These numbers are managed under the company, i.e. Bob, Sue, and Jane, the CFO controller, right? What about reviewed? Reviewed is higher level. Reviewed is higher level. What is reviewed? This is where George, the independent CPA, goes out to the business. And he goes out to the business. And he sits down and camps out in their conference room for a week. And he not only reviews what he's already received from Jane, but he dives deeper into their books to make sure their procedures are in compliance with GAAP. What does GAAP stand for? GAAP. Sawyer.
Generally accepted accounting practices.
Very close. General accepted accounting principles. Good. Jim, like write that down in your notes. Generally accepted accounting principles. Generally accepted accounting principles. Are the books clean? No, not necessarily. Are they audited if they're reviewed? No, but they're definitely higher level than compiled and definitely higher level than company prepared. Now let's go to the audit. Oh, your favorite, mine, Anthony. This is top bill. Anthony, do you even see these often?
Not often.
Not often. Mike, do you see audited statements often?
No.
Whoa, do you hear that? Would it be a fair statement, Mike? You see maybe one a year?
Yeah, probably handful more, but
Handful. Josh? No, not Marquette. UP. Moving right along. Put in your notes next to the word audit at the top. Audit at the top, if you would, please. Please, right there. What is the audit? The audited financial statement is this. George, the CPA, independent CPA, goes out to the company. He camps out for a week. He reviews the books per GAAP, just like a review. But in addition, he sends out confirmation letters. If you'll add this to your notes, what are some of the confirmation letters? The first is to the bank. It goes to the branch manager. Now, this is not to bash the branch manager in any way, shape, or form. But oftentimes the branch manager gets these confirmation letters and he or she will fill it out. Well, they're good on the deposit side, but I don't mean to offend. They oftentimes do not have the background that you have, Delisha, to where, so they fill out the loan side and it's not as accurate as if you did it. So I beg of you, Allie, everybody, Trisha, everybody, put this in your notes. Next to audit at the top. When the letter comes to the bank, I would ask the branch manager politely, he or she, you do the deposit side, but let me and or my team do the loan side of the confirmation letter. Is that a fair deal? Okay. Let's continue on audit. What else consists in the audit? Confirmation letters on the company's receivables and payables, Anthony. I'd write that down. I'd write that down to well. On the receivables and payables. If the list is too long on the receivables and payables, if the list is too long, please add this to your notes. Most CPAs like George will do what is called a sampling. Does that make sense? They will do a sampling. You'll do a sampling, if you will. Okay, here we go, here we go, here we go. Third, confirmation letters. First to the bank, and it's simultaneously, but number two, ARAP, aging, or the companies, the matchup. Third, the company's legal counsel. The company's legal counsel, Nicole, Noel, not Nicole, Noel. Noel, here we go. The firm's legal counsel. So what happens is they want the attorney to state in writing, number one question, is there any legal issue pending against ABC LLC? If it's no, done. Sign off, date it, boom. The attorney sends it back to George, the CPA. What if the answer, Noel, is yes? Woo. Then they have to go down below and they have to answer the question. Describe the legal action, number one. Number two, yes or no, attorney at law. Will this legal action, could this legal action impact the business in a negative way, in a material negative way, Josh? Does that make sense? That's the word, in a material negative way. If it could impact it, but it's immaterial, not material, who cares? Does that make sense? Some attorneys, like Christian, attorney at law, based in Lansing, he does not want to sign these letters because he's sticking his neck out on the chopping block. Is that a true statement? Alicia, is that true?
Yes.
Noel, is that true?
Yeah.
Is that true, Alan? Is that true, Mike? Is that true?
Yeah.
Oh, yes. Sometimes the CPA and the attorney will do this over this issue. Sometimes the CPA will say, I can't issue an audited opinion until I get that letter. And if the attorney either slow or refuses to do it, guess what? The audit will not be completed. 4 levels of an audit. Unqualified, off to the right of unqualified. So if you'll please put in your notes clean, the word clean. Unqualified. It is a clean audit. It's not perfect, Tricia, but it's clean. qualified audit. Jonathan R., qualified audit. 1 or 2 or 3 violations of GAAP, generally accepted accounting principles. 1 or 2 or 3 violations of GAAP. How about adverse? Put in your notes, multiple violations of GAAP. Multiple violations of GAAP. What about disclaimer? Put in your notes, please, the word run. Put in your notes, Mike, put in your notes next to disclaimer, run the other way. The books are so messed up. The CPA cannot and will not render an audit opinion. Wow. Which is the only level of an audit that a bank traditionally will accept? Unqualified, top bill. What about notes? Team leaders lead a 1-minute discussion. What are notes to the financial statements? Do you see them in company prepared financials? No. CPA compiled? Probably no. Reviewed? Yes. Audited? Yes. What is it? What is this? Discuss it briefly as a team. What do we mean by notes to the financial statements? Take just a moment. Work together. The top bill.
Makes sense.
Yeah.
Yep, that's what makes sense. Yeah.
Okay, here we go. Here we go. Tricia, can you tell us team number 4? What do we mean by the notes to the financial statements? What is that?
I'm going out on a limb here. It's the notes from the CPA as to the quality of the management within a summary explaining how they've operated their business and what they may have found.
Ooh, that's close. A little off, but that's close. Delisha?
So we have information not contained in the four financial statements in order to understand how. the
Oh.
financial statements get together.
Tricia, usually it's not, they're commenting on management, but more on the commenting on the detail of the financial statements. Does that make sense?
That was just way too obvious.
That's all right. Sawyer, any other comments on notes? You talked about it as a team. Team 1, Josh?
We just said an explanation of reasons why it was done.
Whoa, explanation of reasons why certain things are done in the financial statements. That's good. Good, excellent. Do we have notes to the company prepared financial statements? Do we have notes on an audited? I put in your notes, excuse the pun, right below notes. Please, everybody put in your notes. Don't be afraid to pick up the phone and call George. Jonathan S., don't be afraid to pick up the phone and call George. Jonathan R., don't be afraid to pick up the phone and call George and say, George, I don't understand. Note number 5, note number 8, note number 13. Now, what gets really scary is when you do that, Delisha, and George says, I don't know, call Jane. Jane says, I don't know, you need to talk to Bob and Sue. Bob and Sue says, I don't know, talk to George. Does that make sense, Al? It just rotates you around. Turn the page, please, everybody. Okay. Page number 10. Whoa, our first polling question. Team leaders lead a quick half-minute discussion and answer this question. The accounting cycle consists of how many steps? Hey, just a moment, team leaders. Okay, here we go. We'll start with team number 2. Sawyer, team leader, what's the answer? A, it's 10. Excellent. Delisha, team number 3, can you name what is the first step? Business transactions, good. Mike, team number 4, can you tell us what is the 10th and final step?
The post-closing trial balance.
You hit it on the head, the post-closing trial balance. And team number 1, jumping back, don't turn back, but jumping back to our discussion, pardon me, of risk in the financial, in the accounting cycle, which one of your biggies? Adjusting entries, they hit it on the head, step number 5. Adjusting entries. For most people, most credit analysts, most loan officers, commercial, that is the biggest. And I'm going to tell you from a true accounting internally within the business, it's the biggest as well. Moving right along. Let's turn, excellent teams. Turn to page number 11. Now, let's go ahead before we jump into our next. Now, we've completed this first part of financial statement analysis, a part that so many commercial lenders overlook. Why? Because they jump to page number 11 and then they start. Does that make sense? The underlying financial statements, I'm going to say this off the record. Team number 4, team numbers 3, 2, and 1, this doesn't get repeated. The company only shows George, the CPA, what they want him to see. Does that make sense? And the reason why, they know if they show it to him, he may be under obligation to do what? Show it to the IRS. Does that make sense what I'm saying? Now, as I train the CPAs in the beautiful state of Michigan, I have to soft pedal what I'm saying. Because in their mind, oh, no, they are the captains of all information for the company. And that is not necessarily true. They are the controllers of, not controller like CFO controller, but they control all information, and that is not true. Does that make sense what I'm saying? So, I will say this doesn't leave the room as well. My observation, both sides of the table, as a former lender and as a CFO today, your borrowers will actually show you more of the real truth than they show their own CPA. Because they know I show my banker, the banker does not give it to the IRS tradition, whereas the CPA may be under obligation to do so. Does that make sense? Just a thought. Let's move forward. Let's take a quick break, our second break of the morning. We'll come on back and we will roll into key racial analysis extraordinary. Have a quick break, everyone. Thank you.
You're killing it.
All for me is about 7 hours. I got stuck.
Yeah, that's good. gonna sit here, so I'm not on. Which goes to- Oh. What was your major? Whoa. It's Hillsdale. That's not the same as. Where's the swanky neighborhood to the west of Detroit? Is that Green Hills? What's it called? What's it called? It's, yes, that's what. I kept thinking, you said Green or Hillsdale? I kept thinking, because it's straight.
Oh, yeah.
It's straight, and I got confused when you said that. And then when you said you were down on the border, I kept thinking, no, it's a suburb with a lot of money to the west. It's not that far from Detroit.
Not at all, yeah. It's really.
Half hour or whatever, but it's where it's traditionally. It's Farmington Hills. Is it, okay, it's Farmington Hills, and there's another one, but there's a cluster in there.
Yeah.
Big money, they're west of Detroit, Metro, but there's those. Well, the one, you got a state building, Georgia, see, I know Georgia. Because the government of the state back in the 60s, I got a state office building right on the corner. And then Mitt Romney, of course, his son ran for office. He was governor of Massachusetts. But he was raised, Mitt was a senator today. Was raised in that big Detroit. Yes, because from his business, dad was an executive. So that's how he got his claim to fame. He rose up in the ranks, became an executive, and then ran the company. There was a two-term government. And I don't know if you know this, George Romney also ran for president of the States. And there is some, when you drive over here, it's Romney, it's right around the corner. It's Romney, not Mitt.
Right.
So Mitt was raised in all of that infrastructure and wealth.
Exactly.
What was that? From Detroit. Yes.
Yeah, for sure.
Well, that's. Detroit's improved though from what I've seen.
Yeah.
They went through bankruptcy and so forth. Another minute. Yeah, as soon as they come back, that's kind of murky. Whoa. Yeah. Okay, so. Oh, really? So, Hope. Which school again?
St.
What's it called?
St. Norbert.
Where's that?
Red.
Oh, it would. Gotcha. Team 1, team 2, we're just gonna wait. As soon as we see them pop up, we'll know it's time to start. No, by the way, before I forget, there's sodas, there's water, there's coffee. I mean, this is nice to set up, and there were no treats this morning, were there? I didn't see any, were there? I don't think so, but lunch, they'll bring the lunch in, and we won't even see it. They go behind, and then they lift that thing up, so. And then we could sit here, or you could even grab one of these chairs and just sit, whatever, you know. These are rather new. They had them upstairs, they said, but these are new to the room. Since I've been here, since it's weird coming back to some of these places. I have trained, we're on break still. I have trained in this room for years. And when I looked at it, it was like, and they changed some of the pictures, you know, it's like a time warp. And am I the only one with the era of COVID? It's like some things are like a time warp.
Coming
it's
back
kind
to
of,
them,
yeah, pardon me?
coming back.
Yeah, it's just kind of weird. Yeah. Did any of you have to go home from the bank? Or wherever you were employed, Josh? So you went home,
Nope, I was there all the time.
okay? Wow. There's some places I trained, the entire classes, oh, we all went home. Other states, nobody went home. I'm serious. And they're bankers from all over the state.
We had people that went home, but the ones that had to stay, we had to carry some letter around the stuff we were.
Oh, really? The, our son-in-law works for a large credit union. He's a banker, but he worked at Wells Fargo for years. He's in this multi-billion-dollar credit union, which is really a bank. And they went home, and because of that, he only has to go into the office 1 day a week. So he gets to work from home 4 days, which is great. No commute except 1 day. And the commute is not that far geographically, but the way the traffic is, and so he's got his office set up in there downstairs, you know. It's kind of a split level, sort of a basement area. And he's like, oh man. So, but he does go in. Let's see, they're back. Okay, let's continue to roll. All right, page number 11. Now we're gonna shift into more of the traditional key ratio, but we're gonna take this from an advanced perspective. Before we talk about the actual key ratios, the Laylock model, look on page number 11. Here are the 4 players. If you will take your highlighter or pen and circle creditor, investor, management, and guarantor. Look at creditor. Let's start with that. Circle or highlight bank loan officer. That's you. Now you could be a bond rating analyst. We talked about bonds. What is the main gist? What is the major gist of a loan officer? Can the company pay its debt via cash flow? I would highlight cash flow, which is one of the main themes of today's class. That's why later on, after our lunch break this afternoon, we're going to go into that section. Section number 7, specifically 5 advanced cash flow models to the max today. Stock analyst, if you would, under investor, highlight stock analyst. They also look at cash flow to a degree, not like you do. Management, highlight business owner and highlight manager. Right above business owner, if you would put the letter P. And right above manager, if you'll put the letter A. The letter P above business owner. What does P stand for? Principal. Put in your notes Bob and Sue. Bob and Sue. Bob and Sue are the principals of ABC LLC. Is that true? What does A stand for? Agent. Put in your notes CFO Jane. CFO Jane, the CFO. She is their agent. Is that a true statement? She represents Bob and Sue to you, Christian. Lastly, highlight the words under the business owner, related analysis. If we do not look at Bob and Sue's personal financial statement, their personal tax returns, which we will do tomorrow, we miss half the story. Would you agree with me? Jonathan S?
Yes.
Would you agree with me? Jonathan R? We miss half the story. Would you agree?
Yes.
All the way. Thank you. Turn the page. Here we go. Rock and roll. Turn to page number 12. Now, here's the Laylock model. Laylock model. LALOC. Okay, here we go. Here we go. Grab your highlighter, your pen. If you'll please circle L for liquidity, A for activity, L for leverage, O for operating performance, and C for cash flow. LALOC, this little quick acronym. If you'll please put in your notes a definition to the right on each of these 5. What is the definition of liquidity? The company's ability to service its short-term obligations. Short term, less than 12 months. Short term or less than 12 months. Another way to define liquidity, the nearest to cash. The nearest to cash, Tricia, the nearest to cash. How about activity? Defined as follows. Swing factors, turn factors, turn factors, swing factors, turn factors, Noel. They swing up, they swing down, they turn up, turn down. We're going to look at AR, AP, and inventory turnover. Accounts receivable, accounts payable, inventory turnover. Number 3, leverage. The company is defined as follows. The company's ability to service its long-term obligations. Leverage, the company's ability to service its long-term obligations, more than 12 months. Think in terms of 3, 4, 5 years out. 3, 4, 5 years out. Operating performance, the profitability of the business. Ali, the profitability of the business. Number 5, of the Laylock model, cash flow, defined as follows, Josh. Cash in versus cash out. Cash in versus cash out. Another way to define cash flow, lifeblood of the business. The lifeblood, Anthony, the lifeblood of the business. I put that in your notes, the lifeblood of the business. Cash flow, cash in versus cash out. Okay, we're going to do a quick activity, 2 of them actually. To the left of activity, or pardon me, to the left of liquidity, part A, model 1 of the LALOC or Laylock model. And one line up about right there. If you'll put short term, just to the left of liquidity and up one, you should have enough space in your margin there. But short term, less than 12 months. How would you rank the 5-step model? I'll give you a hint. Number 1 is cash flow. I put it right there next to cash flow. This is short term. This is less than 12 months. This is less than 12 months. Less than 12 months. How would you rank the 5-step model considering we're talking less than 12 months short term? Number 1, the hint is cash flow. What is number 2? What is number 3? What is number 4? And what is number 5? What is number 2, number 3, number 4, and number 5? What is number 2, number 3, number 4, and number 5? Short term. Sawyer, short term. The hint is, give you the first one. Number 1 is cash flow. Team leaders spend about 3 minutes on this with your team. What would be number 2, number 3, number 4, and number 5? We'll start with team 3 and rotate. Right on. You were right on. You were right on. Oh, great. Rock and roll. Rock and roll. You were right on it, Josh. You were right on it. Team 4, take just another minute or so. Okay, just another minute or so. Okay, we're gonna start with Mike. Mike, number one's cash flow. What did you put for number two?
I put liquidity.
You are right on the money. Tricia, what's number three?
I put term factors,
Which is activity, right?
activity. Yep.
So number one is cash flow, number two, liquidity, number three is activity. Delisha, what's number four?
Operating performance.
Operating performance is correct, and number five is leverage. Number one, cash flow. Number two, liquidity. Number three, activity. Number four, operating performance, and number five, leverage. Excellent. Questions on that, Josh? Nope. Sawyer? Okay, here we go. To the right of the definitions, to the right of the word liquidity, and one notch up, right up here, put long-term, 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 more than 12 months. Think even in terms of 3, 4, 5 years out, way out. We're going to reprioritize the model. Let me give you the hint. Allie, number one is still cash flow, she says, and I agree. Cash flow. What is number two? What is number three? Cash flow is still number one. What is number 2, 3, 4, and 5? Number 2, 3, 4, and 5. I'll start with team number 2 and rotate. Think in terms of the overall picture of the company for number 2, the overall success of the business. I love it. Christian, you do look like you love that. So people say that all the time, don't they? Yeah. Does that drive me crazy? I would. You guys would. Take tea. It's in Appleton. Yeah, that's fun. I know.
Wow.
Take just another half a minute on this. Okay, here we go. We'll start with Jonathan R. Jonathan R. Number 1's cash flow. What's number 2?
Was 2 leverage?
Leverage, no. What's number 2? Deletion.
Liquidity.
No. Sawyer.
Operating performance.
Operating performance is correct. Number 1 is cash flow. Long term, 3, 4, 5 years out. Number 2 is operating performance. If the business does not reach positive operating performance, that's called profitability. In the long term, traditionally it will fail. What is number 3, Josh?
The leverage.
Leverage is correct. What is number 4, Alicia? Activity. And Trisha, what is number 5?
Liquidity.
Liquidity. It is cash flow number 1, operating performance number 2, leverage number 3, activity 4, and number 5 is liquidity. I'm going to say it straight out. Big picture, long term, you've got to reach profitability and you're dead. Is that true financially? Do you agree with me, Jonathan S? Yes. Yes. Moving right along. Excellent. This is the big picture of the Laylock model. Now let's turn forward. Turn forward to page number 13. Page number 13 and 14 is our next case study. Remember, I mentioned we've got multiple case studies today. This is Snyder Corporation. This is a small manufacturer located right outside of Green Bay, Wisconsin, in the Green Bay market. About a little over an hour from Appleton. Is that true, Christian?
It's like 20 to 30.
Yeah, it's even less than an hour. Depends on what part of Green Bay. You go to Sturgeon, or if you go to Sturgeon Bay, let's see.
It's about an hour.
Yeah, it's about an hour. But Green Bay will say, yeah, half hour, whatever. Okay. I'd like you to take just a moment. Everybody individually, the teams, after you do the individual, take a few minutes and review, discuss the numbers. Look at the balance sheets. This is a small manufacturer in Green Bay area. Snyder Corp. These are in actual numbers. These are not in thousands. These are actual. Okay, small manufacturer. This is not ABC LLC. Take a moment, look on page number 13 and page number 14. Page number 13 and page number 14. And take a moment, just review both sets, both the balance sheets and the income statements. Take just a couple of minutes and discuss it as a team. Team leaders, lead a quick discussion, please. Take a moment. Team number 4, if you'll do the same, of course. Take just another moment. Take team leaders, lead a quick discussion. Talk about some of the trends of the business. For example, 2020 was a pretty rough year. Would you agree? So take a moment, take team leaders, lead a quick discussion about the strengths, weaknesses of the business. We haven't even touched the key ratios. We will in just a moment. But just based off the financial statements, take a moment more and review page 13 and page 14. Okay. These are actual numbers, manufacturer, Green Bay area. But it was just me. Okay, here we go. Let's talk about page number 13 and 14. Page number 13, the balance sheet. Page number 13, the balance sheets. If you look with me on this, whoa, you can see the assets, you can see the liabilities, you can see the owner's equity or retained earnings. You can see the common stock. Team number 3, Anthony mentioned, wow, common stock went from 460 to almost 1.7 million. What happened is the owner, his name is Sawtooth. What? That's his nickname. He's not originally from Green Bay. He's actually originally from the Western US, place called Idaho. There is a mountain range in Idaho called the Sawtooth Mountains. When he went to college in Wisconsin, he got a scholarship to Green Bay. What college or university is in Green Bay, Christian?
St. Norbert.
St. Louder.
St. Norbert.
St. Norbert. How do you say it again?
Norbert.
Norbert. Norbert?
Norbert.
Norbert. He went to college there. He got a scholarship because he was playing volleyball. Do they have volleyball there? They do. He had a full scholarship. The first day in the dorms when he was a freshman, they said, "Where are you from?" He goes, "Idaho." "Where in Idaho?" "Oh, I'm from the Sawtooth Mountains." They laughed and his nickname became Sawtooth. Fast forward 25 years later, he still is in Green Bay. He graduated, he took an internship, he did an internship with a small manufacturer. The old man, everybody called him the old man, he even called himself the old man, owned the firm. 15 years later, he takes Sawtooth aside one morning and goes, "I'm ready to retire. I'm going to give the company to you. I'll sell it to you on terms that nobody would ever get." He actually became almost like a father figure or father-in-law figure to Sawtooth. Bottom line is now Sawtooth owns the business. But what did he do in 21? He sold off part of the business. Now, the old man has been retired, actually passed away a few years ago. So he's been out of the business. Sawtooth sold it to gain, to recapitalize the business, partly because of the loss. Is that true, Anthony, in 2020? What did he do with the cash? You financial statement analysts, what did he do with the cash? Did he get on an airplane in Green Bay and fly to Vegas and spend the 1.2 million? Can you see the 1.2 million, Josh, where he gathered that? Can you see it? The difference between 460 and 1,680,000 is about 1.2 million. Is that true? Can you see that, Sawyer? Mathematically, did he go to Vegas and blow the money? Yes or no? How quickly, Alicia, can you spend 1.2 million in Vegas on any given evening? How many minutes? 2 minutes?
I don't know.
To the average person, well, let's ask Trisha. Trisha, how quickly could he spend the money, Trisha?
Well, it depends on what he's purchasing. In Vegas, I'd say probably 30 minutes.
30 minutes? Even if he just participated in that little known event or activity known as gaming. We don't call it gambling. Ooh, that's too edgy. That's too edgy. It's called gaming. It's funner. It's more polite. A good evening, he could blow the 1.2 million. There are some rooms in Vegas where every bet is $1 million. So one bet, 2 minutes, Alicia, 2 minutes. She's right. Every bet's $1 million. There are even some that every bet's 10 million. And people will play all night long. They'll blow $100 million in one night. And so you're looking at me like, no, that's just made up. That's not made up. That's not made up.
This isn't disbelief, this is disappointment.
Yeah. Woo, these are multi-billionaires that are flown in from all over the world. They'll play all night long. Every bet's $1 million, 5 million, whatever. Oh yeah. It's just, I mean, it's all relative to most of our finances. Moving right along. Let's turn from the balance sheet. By the way, Anthony, how much percentage of the business would he sell and still retain control of the business?
49%.
You hit it right on the head. Meaning he still owns 51%. Let's turn to page number 14. Here we have the income statement. What happened in 2020, Christian? Was there a loss?
There was.
They blame COVID, but the truth of the matter is they bid on 2 of their manufacturing jobs wrong. They simply had a little glitch in their Excel spreadsheet that they used to bid on the jobs, and they took it on the chin. But like a lot of businesses, even if COVID was, if it was related to COVID or not, it was COVID. Is that a true statement, Jonathan S.?
Yes,
Did you see that with your customers, Jonathan S.?
yes.
He did, you bet, absolutely. Moving right along, here are the industry comparisons. Everybody, if you will highlight or circle current ratio 2.7, quick ratio 1.0, inventory turnover 6.1. Circle those first 3. Also circle or highlight day sales outstanding, which is the same thing as AR turnover, the same thing as AR turnover. And then if you will go down to, we'll do one more, debt ratio of 2.0. Debt ratio of 2.0. Okay, now we're going to just do some of these calculations after our lunch break. Everybody to set us up for right after lunch, if we will turn forward, please turn forward to page number 15. We're going to stop right there. When we come back from our half-hour lunch break, we will go ahead and work on these models mathematically. We'll grab our cell phones on our calculators, a separate calculator, and or if you have Excel, that would be great. Okay, so we'll work on these. Today is not the Q ratio class. That's a whole day where we crunch till the cows are coming home, till the cows come home. But we will touch some of these and we'll do them quickly. To illustrate each one of these key ratios, we will also do related or advanced concept. Is that a fair deal? So we're going to crunch the first 3 of the Laylock model: liquidity, activity, and and leverage. You'll notice the flow or order of the Laylock model is a little different than the actual either short or long term, right? It's the more traditional that most banks will use. But in fact, most banks will reserve or touch cash flow at the end. Does that make sense? So we're gonna use the traditional order, even though we did our activity earlier, short term versus long term, right? Perspective. Good. Any questions on the direction right after lunch? Ellie, questions? Tricia, any questions?
Nope.
Got it. Mike, any questions?
Not right now, no.
Noel, questions? Okay, let's go ahead. Let's come back at about 20 after 12. So we'll take a half-hour lunch, come back at about 20 after 12, and continue the saga forward. Lunch is served. Lunch in the back for the ground-based. Have a good lunch, everyone. Team number 4 as well. Talk to you about 20 after. Pardon me?
Yeah, I know. There are no names. Certainly can.
I appreciate it. Allowing me to, see what we did. So very much. How about a drink and a break?
Yeah, I think I might be able to do it.
Oh, even that,
Yeah,
even that for both of the next sections, good.
yeah.
That's a
So,
good idea. Somebody, no, did you, who said they had a loan officer coming tomorrow?
Friday.
Friday, so you'll see, you're here all through. You'll see, we'll have other people, so we'll keep the team set up, just like this, you know. Yep, so. Just don't want you to feel like you're out in your loans.
No, an hour, 10 minutes.
So how far? from- Stephanie, I'm using the mouse. The keyboard just kind of died off, so the mouse worked perfect.
No, I don't want to pause share. I want to pause the recording.
That's why I sit over here, take breaks.